So welcome to our fourth lesson of the Master in Innovation Management of Ascheri Academy. I hope you will find this lecture enjoyable, pleasant, and instructive. In this model, we will deal with fintech, and I called this lecture When Finance and Technologies Combine Their Forces. With this slide, I want to give you a hint of the history of fintech, because we are prone to think that fintech is a product of our recent years, but instead the basic concept of fintech resides on the early credit cards in 1950s, but also in the ATM machines of the 80s and 90s. So it's not just something just related to the latest technological breakthroughs, but fintech it's something that was already present in our daily lives. In fact, thanks to debit cards and credit cards and also ATM machines, we were already able to withdraw cash, for example, to make payments, avoiding in this way the physical deposit, for example, of currency on the bank. So the first hint of fintech is represented by the ensemble of debit cards and credit cards and ATM machines. But what is exactly fintech? Fintech, or financial technology, is a term that refers to software, to mobile applications, and other technologies that are created to improve and to automate traditional forms of finance for businesses and consumers alike. So fintech include a vast plethora of technological tools. So includes everything from simple mobile payment applications to complex blockchain networks that houses encrypted transactions. So it's a very vast domain, and it's very important nowadays. I want to indicate, with this slide, I want to indicate some types of fintech services, but I challenge you to add other ideas, other fintech services that you can think that are modern, that are useful in our daily lives. But anyway, just to have a rough idea, for fintech company, we describe any business that uses technology to modify, enhance, or automate financial services for business and consumers. And some examples include mobile banking, peer-to-peer payments, automated portfolio managers, platforms for development and trading of cryptocurrencies, e-wallets, digital money, mobile payments, crowdfunding platforms, peer-to-peer lending, payment gateways, and digital loans. But I want you guys that you had other ideas, other fintech services that maybe you are still using. This is a map because let's enter in. We have to enter in our in the core of our discussion. This is a map of the main technologies that enable the financial technology panorama. In the first place, we can quote the mobile or the mobile banking. In fact, in the first place of fintech, mobile banking connects the end user to a variety of financial services and enables financial transactions on the fingertip anywhere, anytime. So the first technology that we can recall in talking of enabling technologies is mobile banking. The second technology, and maybe the most famous, I dare to say, is blockchain. Blockchain uses distributed smart contract system to create a transparent, secure, immutable, and reliable ledger to document contracts, transactions, and records. Cryptocurrencies based on blockchain technology provides safer, faster, and independent digital transactions. The third technology that we can recall in talking about enabling technologies are big data. New data sources such as mobile banking and Internet of Things provide an additional layer of data gathering. Big data analytics are necessary to rapidly and effectively combine these data sets for better insights. So another point to keep in mind. The fourth enabling technology is artificial intelligence. Artificial intelligence is based on historical data. It can improve solutions and decision making. It also brings advancements in chatbots, in robo-advisors, and other automated advisory solutions for customers. The RegTech. The RegTech is a less famous domain, but very important, like fintech. But the RegTech is a special domain that groups all the technologies that helps businesses in coping with legal requirements. So services and tools using big data and cloud computing to enhance a company's ability to monitor, report, and comply with regulatory requirements. So all the tools, all the instruments that a company has to respond from a regulatory point of view. The other technology that we can quote is biometrics. Also, with all the discussion that this meaningful concept brings, especially in these modern times. But anyway, biometrics uses physically unique features of an individual, like fingerprints, face, voice, and retina, and other forms of recognition to enhance security and identity verification. So although this area, this technological area is sometimes questionable, you have to know that in some sectors this technology is mandatory. For example, in some military premises, or in certain banks, for example, the employees can enter through a biometric scanning. The last enabling technology of this time, and especially of this map, is open banking APIs. And the APIs stays for application programming interfaces, interface. So through open application programming interface, banks can give not only users, but also partners more transparency and access to banking data and encourage the creation of new value chains and services. So the APIs, so this kind of intermediary softwares that helps two different applications in talking with each other is a key in developing all the open banking applications that we currently use. In this slide, I indicated other technologies that enable the fintech arena, but you can indicate other too. I put the robotic process automation today present always in, for example, in some banking services. I put cloud computing, Internet of Things, software as a service, the 5G and 6G network in certain places, digital twins, metaverse, virtual reality, and augmented reality. So you name it, the other ones. But these are the completing slide to the present one. I want to show you this video because it's a very simple video, and it's a report of the CNBC International. But let's watch.
If you've ever paid for something with your phone, transferred money using an app, or checked your bank statement online, then you're already part of a multi-billion-dollar industry. It's called Fintech, and it's changing economies around the world. Fintech is short for financial technology. Seems simple, right? Well, the term Fintech includes a huge range of products, technologies, and business models that are changing the financial services industry. It refers to everything from cashless payments to crowdfunding platforms to robo-advisors to virtual currencies. So every time you donate to someone's Kickstarter campaign, that's Fintech. Or if you transfer money to someone using Venmo, that's also Fintech. And that's just the beginning. Here at a major Fintech conference in Amsterdam, hundreds of companies are trying to disrupt the banking and finance industries by changing the way we pay and borrow money. And investors are buying it. Global investment in the fintech sector has added up to nearly $100 billion since 2010. In 2017 alone, fintech investment surged 18%. Startups focusing on payment and lending technologies received the majority of those funds. It's not just startups that are getting into fintech. Some of the world's biggest companies, from Apple to Alibaba, are going big on it too. Just think of Apple Pay or Alipay. One reason for all of this investment, consumers are adopting fintech fast. 1 out of every 3 people across 20 major economies report using at least 2 fintech services in the last 6 months. China and India are leading the way, with more than half of consumers using services like money transfers, financial planning, borrowing, and insurance. Financial technology has filled a void for people around the world who don't have access to traditional banking services. In fact, it's estimated nearly 2 billion people worldwide are without bank accounts. Now, thanks to fintech, all you need is your phone to take out a loan or insurance. Take Kenya, which pioneered a mobile banking system called M-Pesa. Kenyans access their M-Pesa accounts directly on their mobile phones to transfer money, pay bills, or take out loans. Today, an estimated 96% of households in Kenya use M-Pesa. And one study found it has helped lift roughly 2% of Kenyan households out of extreme poverty. The rise of fintech has forced traditional lenders, insurers, and asset managers to embrace new digital technologies. For example, wealth managers now have to compete with robo-advisors, which are automated financial planning services. I mean, talk about rise of the robots, right? Thanks to high-tech algorithms, these services are available 24/7 and can be more affordable than traditional asset managers. That helps explain why some robo-advisors already have billions of dollars under management. Like any growing industry, fintech isn't without risks, and some regulators have struggled to keep up with the fast pace of innovation. Think of peer-to-peer lending platforms, where individuals borrow and lend without going through a bank. Compared to traditional banks, these services might not be required to set aside as much money in case customers default on their loans. This can be risky for companies and consumers. Data privacy is another major concern. As more financial services go digital, cyber attacks become a bigger risk. The challenges facing financial technology are likely to grow as more businesses go digital. But for many of the companies and consumers here, fintech is more than a buzzword. It's a big business opportunity.
Okay, so we have seen an appealing video of CNBC International that has shown the features of fintech in a very understandable and simple way. There are some points that I want to stress after watching this video. For example, the journalist pointed out that there still are some issues to resolve around fintech. For example, problems related to data privacy, data breach, security, and for example, the risk of default in case of peer-to-peer lending platforms. But there are also some very beneficial aspects, and we will deal with it later, but some beneficial aspects, for example, the possibility of giving accounts, of giving access to banking services to people that are not usually banked. And we are talking about 2 billion persons around the world that until the emergence of fintech were not able to have some basic financial services like insurance, like pension, like legal investment. So there is also a beneficial aspect, and we will observe it also later. Okay. With the subsequent slides, I want to draw your attention to the extensive possibilities brought by the fintech, the financial technology sector. For example, if you are a tech startup, it's possible that you will find many fintech investors interested in developing your idea, your core business. And in fact, fintech investors tend to be very knowledgeable about the industry and are usually willing to take on more risk than traditional investors. So it's good news if you are thinking about new ventures, especially technological ventures. Moreover, fintech investors are typically more patient than traditional investors, than traditional hedge funds, for example, and are willing to give companies time to grow and time to scale, because they are well aware that it takes time to launch and to diffuse new technologies in order to render them adoptable by consumers and businesses. And finally, there is a strong alignment between the interests of fintech investors and the companies they invest in, because the main reason for this kind of partnership is the success of the company, is the success of the technology developed. So this alignment of interests creates a strong union, a strong partnership between the two parties, and can lead to better outcomes for both. So if you are thinking of some tech startups, maybe you can consider to pitch your ideas to fintech investors in order to raise funds. This cute robot in the left part of our screen is representing the explosive domain of robo-advisors. And robo-advisors represent a branch, kind of wealth management brought thanks to the financial technology. So robo-advisors are automated solutions based on artificial intelligence and machine learning technologies, as well as algorithms that help with financial management. In fact, the growing interest in stock trading and other types of investment lead to robo-advisors becoming one of the key trends among the wealth tech applications, which are focused on helping people with finance management and also their investments. Moreover, it's estimated that the size of assets managed by automated investment advisors, so robo-advisors, is going to reach $4.6 trillion by 2023. So, guys, let's keep attention on this sector, because I think that it's a very explosive domain with profitable perspectives. Moreover, for example, these robo-advisors permits represent an affordable way to get regular personalized investment advice. So for you that maybe trade or trade some stocks, or ask, for example, for advice in your investment, it could be good, either to say an optimal replacement of the traditional wealth management. This slide is very important because it contains two different aspects, two different industries that, in a certain sense, fintech is reshaping: the industry of banking and the industry of payments. So the very simplicity that underlies banking products and all the processes associated for savings, for lending, and for business services renders the sector open for disruption. In fact, the majority of financial executives were already perceiving this possibility of being disrupted by fintech. So new entrants, new companies, new tech companies especially, saw the opportunity in disaggregating, in dividing the components of traditional banking and offering targeted solutions with better servicing to both retail consumers and businesses. So the first industry that was disrupted by fintech was the traditional banking sector. But the second industry that was disrupted, that was revolutionized by the emergence of fintech was the industry of payments. In fact, the disruption of the traditional payments ecosystem has been rapid and impactful. Fintechs, so fintech companies, have grasped an opportunity to leverage their technological capability and also their direction towards customer centricity in order to expand into payments. So in the midst of this disruption, a new section of digital players has emerged, the paytechs. So nowadays we have fintech companies specialized in payments that are called paytechs. So the second industry that was disrupted by financial technology. In this with this framework, I wanted to show you a simple idea, a simple underlying idea that entails the shift from open banking to open finance. Maybe you have already heard this term open finance, but let's explain what is it, open finance. Open finance is the next step of open banking. While open banking enables account information and payment initiation services, so very basic banking services, open finance will encompass more financial products and services. So not just banking, it's something more. Open finance works on a much larger scale than open banking. It can allow authorized third-party service providers to access a wider range of customer data from various accounts, including savings, pensions, investments, insurances, mortgages, and many more. And this ecosystem of data could be used to create and offer more personalized financial products. So if you remember, customer centricity is the key point. So offer more personalized financial products and services. There is another school of thought that continues in developing this simple framework. And this school of thought entails that we passed from open banking to open finance, and then we are passing from open finance to open data, because this new ecosystem implies the utilization of personal data in a more targeted way for offering the new products and new service to customers. This is a simple explanation of decentralized finance. Guys, I want to stress that in order to explain completely the concept of decentralized finance, maybe we would have another master, so other 10 lessons. But I want to give just a simple indication of what decentralized finance is, because fintech could be considered as a means useful for developing, for deploying decentralized finance. So this slide is not exhaustive of the entire concept of decentralized finance. But anyway, decentralized finance is a new financial paradigm that leverages distributed ledger technologies to offer services such as lending, investing, or exchanging crypto assets without relying on a traditional centralized intermediary. It can be defined as a competitive, contestable, composable, and non-custodial financial ecosystem built on technology that does not require a central organization to operate. So this is an official definition of decentralized finance. This definition was written by the Bank for International Settlements. On your right side, in fact, I added also an image in order to better explain this important concept of decentralized finance. And I think that with the framework that I took from Financial Times, you can easily understand this notion. In fact, in the traditional financial system, you see two banks that act as intermediary between the sender and the receiver, between these two kinds of transaction. But in the low part, you see the decentralized financial system. So in the center, you see computers, tablets, and smartphones, because we have a decentralized, distributed ecosystem with no central authority, with no central party, with no central bank that construe the entire financial system. So I think that with this image, you can easily understand the vast concept of a decentralized finance that can extend it, that can purport it through fintech. Another beautiful point, I dare to say, that I want to give you in talking, in discussing with you about fintech, is the point of financial inclusion, because as we were listening, there are about 2 billion persons, around 2 billion persons worldwide, that have not access to the basic financial products and services, but they have a smartphone. And in this way, with this ability to use a smartphone, they can access application solution on their telephones, on their smartphones, and these applications help unbanked people by providing them with first-time access to a range of digital products like instant loans, money transfers, bill payments, high-yield investments, and savings. So I think that in this time in which we think always in respect of diversity and social inclusion, I think that this concept of financial inclusion embraced by fintech, it's a very meaningful, it's a very worthwhile aim that we can remember. For us, it's simple in talking about savings, requiring a loan or transferring money, but for some poor, so, especially in the underdeveloped developed countries, obtaining a loan for starting a new activity, for example, or transferring money, or paying a bill is something that was difficult But nowadays we have fintech that can help in these issues, especially in the underdeveloped countries. So it's a very important aspect of fintech. This is another video. I called this enlightening video because the speaker of TEDx will give you very thoughtful reflections about what is fintech and what could be in the future.
Good morning. Very excited to be here. Let me start by asking all of you a question. Who in the room enjoys their banking experience? Says a lot. Well, I have good news. The good news is we are currently going through one of the biggest transformations in financial history, the fintech revolution. And it's going to transform banking as we know it. What I want to share with you all today is how this fintech revolution will have winners and losers, and that it may have a significant impact on a financial center like Hong Kong. But that those who will be the most significantly impacted by this fintech revolution are going to be those who work in the financial industry. The bankers of the future will be very different from the bankers today, with very different personalities, backgrounds, and skill sets. But first, what is fintech? Fintech, short for financial technology, is the innovative use of technology in the design and delivery of financial services. And it's transforming the banking world as we know it. Things from artificial intelligence, peer-to-peer lending, big data, blockchain, crowdfunding, digital payments, and robo-advisors, just to name a few. But why is this fintech revolution happening now? Historically, as technology evolved, the banking industry was reasonably good at integrating those new technologies in order to better serve customers like yourselves. But all of that changed during the financial crisis of 2008. During the financial crisis, banks were busy dealing with the numerous new rules, regulatory requirements, and fines imposed on them. Punishments they in many cases deserved. But innovation became a very, very distant priority. But at the same time, some of the most game-changing technological innovations that have transformed the way we live have become part of our everyday life. Think about the iPhone, Airbnb, Uber, WhatsApp, or WeChat, for example. And what happened was that a gap was created between what your banks were offering you and what you as a customer came to expect, especially from a user experience and convenience perspective. And that gap is what the fintech industry is tackling right now. But that gap was so big that even non-traditional banking players decided to jump in and capture this opportunity, mainly technology firms. For example, did you know that Facebook has currently around 50 different regulatory licenses in the US alone? Licenses that would allow Facebook users to transfer money via the Messenger app. Amazon recently experimented with offering student loans off its platform. Alibaba's financial arm, Ant Financial, launched a money market fund that has become the third biggest money market fund in the world, dislodging incumbents who have been doing this for decades. That fund has more than 150 million single investors who have, in average, invested less than 1,000 US dollars each. For many of them, their first investment ever.
So the video is a little bit longer, but we can sum up the main important, the main points stressed by the speaker. First of all, he asked what is fintech. So it's the innovative usage of technology for designing and delivering new financial products. But an aspect that I want to point out, a very meaningful aspect that I want to point out of this discussion regards the historical reconstruction of fintech. Because he said that until 2008, we used to receive, to exploit the normal financial product and services that were brought by our banks, our normal financial institutions. But with the market crash of 2008, banks were busy in defining their regulation, their functioning, and they wanted to take to apply new rules, maybe stricter, for avoiding other subsequent market crashes. And this situation created a gap, because on the other hand, we had companies like Facebook, like Apple, like Amazon, like WhatsApp, like WeChat, or Alibaba, that were developing many innovations, many new products in the financial sector. So they jumped, these new companies, very profitable, they jumped in this sector because they found a lack, they found a void in the development of these new financial products. And this caused the emergence of the fintech phenomenon, or fintech revolution, as this speaker called the financial technology. Let's move on. Okay. You know that I'm a practical person, so in this slide I want to talk about numbers. Please, guys, remember that this sector is worth about 165 billion dollars anyway, billion dollars in our 2023. And in this slide, I wanted to show you some famous and most profitable fintech companies. There are many more. We have PayPal Holdings Incorporated, traded on Nasdaq. The company offers a wide range of financial services and products, including online payments, mobile payments, and credit products. The market capitalization is 96.8 billion. There are all updated numbers. Don't worry. Stripe is another famous fintech company. The technological company allows businesses and individuals to accept and make payments over the internet. Its estimated valuation is of $74 billion. Block Incorporated, traded on New York Stock Exchange. Block Incorporated is a leading American fintech company. The flagship product is the Cash App, which allows users to send and receive money without having to use a bank account. Its market capitalization is $39.6 billion. So another monster, I dare to say. And Revolut. Revolut is a British fintech company that offers a mobile app to manage the finance of users. The app permits to track expenditures, to set goals, and to make payments. Its estimated valuation is around $33 billion. There are many more fintech companies. You can do a brilliant research, but I wanted just to name a few, the most successful cases anyway. In this simple slide, I wanted to drive your attention on which are the reasons why consumers choose fintech, choose financial technological solutions. According to this report of EY, the consulting company, the 33% of consumers are prone to use other services other than their main first bank, so offered by other financial providers. For the 68% consumers would consider, I stress this word, a non-financial services company. So non-financial services company for financial services, for the 68% of the persons interviewed. For the of the sample, I was saying. For the 46%, consumers are willing to share their bank data with other organizations. So we come back to the previous idea that we are in a stage that foresees a passage from open finance to open data. So an extension, an evolution of the open finance ecosystem with the sharing of data of consumers. In this slide, I recap the overall benefits of fintech. Customer service and revenue is I think that it's the first one, because fintech enhances the quality of traditional financial services by optimizing efficiency and boosting productivity. It improves security. So fintech introduces the latest security solutions like biometric data, tokenization, and data encryption through blockchain, if you remember. Convenience. Fintech entails the adaptness and convenience of transactions. Also, the speaker of TEDx was talking about convenience. With fintech, we receive valuable advice. So many technological advancements are developed to get valuable information on investments through robo-advisors, as we were saying. There is a high rate of approval in case, for example, of request of loans. So fintech increases accessibility to finance and speed up the process, the entire process. We have a system of upgraded payment. So with fintech, modalities of payment are quickly ameliorated. We have an extension of the service scope. So fintech allows companies to use innovative technology to broaden their reach in their area of service. And also, last but not the least, the cost reduction associated with fintech. In fact, fintech is the most cost-effective option for consumers and businesses alike, because it helps to save money, and there are also no hidden fees in this kind of services. Along with the beneficial aspect of fintech, I wanted also to show you a framework of the risk associated until now, anyway, of the risk associated with the fintech phenomenon. And this template elaborated by the company Aon PLC, I think that is very explaining and is exhaustive at the same time. This framework represents all the risks until now knowledgeable and weigh all the risks associated with fintech, and it divides these risks according the sector, the domain. In fact, we can see strategic risks, regulatory risks, risks of behavior, for example, moral hazard, so risks of conduct, risk of talent management, of people management, operational risks, and financial risk for these latest technologies. You can deepen this slide because it's very interesting. This is the last video, and you know, I want to link our lectures to reality, to our daily problems. And maybe you have, surely not maybe, you have heard about the fallouts of 3 American banks, especially the banks in the Silicon Valley, Silvergate Bank, Silicon Valley Bank, and Signature Bank. Maybe you can think at first that this problem of fallout of these 3 American banks, were related to fintech. But it's not the case, because in this bank we had unfortunately the deposits of some fintech companies in the Silicon Valley. But this problem was not caused by the fintech phenomenon in the United States. But let's listen to some reflection.
Just talk to us about how much the earth shook for VCs, tech. The overall counterparty risk was enormous, and no one seemed to realize.
Yeah, I think the sudden element of this is what hit everybody so hard. And I think, I don't know how many years of life were taken off everyone over the weekend, but there were people super stressed out, you know, getting from not just big businesses, but SMBs and clients of the firm, not our firm, but SVB. But it really, I think, woke people up to the big problem, you know, out there. There's so much risk in a few big banks in Silicon Valley that it really just shook everybody up. And at the end of the day, I think you're seeing the ripple effects happen, and you're right in the middle of it. So I think the probably questions are going to be, you know, how deep is this going to go? But we're still in the middle of it. We're still in the middle of it. And the reality is you have spent so many years here helping firms become unicorns through raising money. You've worked with their venture capitalists. Is there a sense that the capital markets are now closing up for the people who had such easy access to money for the last 10 years? Well, I wouldn't say they're closing up, but I would say this isn't helpful. And given that we're right in the middle of it, it's pretty painful for, I think, a lot of tech companies across the world. I think the fact the Fed came out and did what they did was incredibly helpful and expected to some extent over the weekend. But capital was pretty hard to find before this. And so right now, we're getting hundreds of calls from companies looking for, whether it's credit. I saw Bain on this morning talking about credit funds and structured securities. And and all that. But you see some of the big guys that wrote all the checks leading up to the big boom in tech and fintech, Tiger, D1, Code 2, really kind of pulling back on their private investments and looking at their portfolio companies or shifting to public markets.
Steve, you run an advisory that's at the heart of all these transactions, right? When the venture capitalists wrote their letter of support for SVB, they pointed out that it's not just a place that holds deposits for this sector, it offers a wide range of banking services where no one else would. So now where does this industry turn to? Where do the founders go when they need banking services and traditional banks don't offer them?
Yeah, you're right. It was not just a place where you stored your money. It was where all the money got transferred. They were doing payments. They were doing treasury management. They were doing wealth management, investment banking, you name it. And a lot of companies were essentially running their business off of SVB, not just essentially putting their deposits there. I think, it's interesting to hear SoFi and other fintechs who we know are have their hands out to essentially take deposits and help people out. But that's just one small sliver. The economy in the fintech universe is extremely strong. And I think there's going to be places for people to go. We were on the phone all weekend ourselves and with different clients, helping them get open up accounts at JP Morgan and other large banks and institutions. And that was happening all weekend. And I have to say, in talking to some of the bankers that were taking those funds in, that a lot of them were extremely gracious about the situation and not trying to sort of fearmonger on it. Yeah. So I think there's a lot of support around the banking system for each other.
So as the managing partner was saying, the problem is not fintech because the financial ecosystem of fintech companies is very strong. The company hurt by the three fallouts will simply, if they can, will simply move their deposits into other banks like JP Morgan or other institutions. So the problem, I want to stress that the problem was not the fintech companies that had deposits there. The problem was a problem of liquidity. If I have understood correctly, the liquidity of the three banks, because there was a mismatch in the calculation of duration between their assets and their liability. But anyway, the fintech ecosystem is strong, is exploding, and as we have said, is worth $165 billion. So they will surely find a solution, and they will move their deposits in order to continue running their technological companies.
Systemically important.
Okay. I want to wrap up our lecture. In this model, we have dealt with the brief history of fintech. We have explained what is fintech. We have described some types of fintech services, and also we have described the enabling technologies. We have spoken about some peculiarities about fintechs, so raising funds from fintech investors, wealth management with robo-advisors, and how fintech is reshaping banking and payments industries. We have spoken about the shift from open banking to open finance. We have anticipated a little bit about decentralized finance. We have included fintech as a means for reaching financial inclusion, especially for people of underdeveloped countries. We have talked about some successful cases of fintech companies. We have reasoned about the top reasons underlying why consumers use fintech. We have listed the overall benefits of financial technology, and we have seen also the risks until now associated with it. I put, as always in my lectures, I put a bibliography composed by interesting journal articles, books that you can read in order to deepen this topic, and websites with resourceful means of education.